In late January of 2026, something historic happened twice in the same week. Gold blew past $5,500 an ounce, and silver smashed through $120 an ounce, both setting all time records. Months later, both have pulled back, but they're still up massively from a year ago. So, what's actually driving gold and silver prices in America? And how are these two metals different from each other? Let's break it down. Gold and silver are humanity's two oldest forms of money. Long before paper currency, both metals were minted into coins and used to trade goods across empires. But in the modern economy, they've grown apart. Gold today is almost purely a safe haven asset. Silver still carries that same investment appeal, but it also has a second job as a hard-working industrial metal. That's the single biggest thing to understand about these two metals. Gold is mostly bought and held. Silver is bought, held, and also melted down into solar panels, electronics, and medical devices. That difference explains a lot about why their prices don't always move in lockstep. So, who actually sets these prices? Neither metal has one official price setter. Both are priced minute by minute on global commodity exchanges, mainly COMEX in New York and the LBMA in London, where traders buy and sell futures contracts based on what they believe the metal is worth right now. On the supply side, gold mining has stayed remarkably stable for years, growing only slowly no matter how high the price climbs. Central banks also hold enormous gold reserves, and what they choose to buy or sell can move the entire market. Silver's supply story is different. About 70% of it comes up as a byproduct of mining for copper, zinc, and lead, so production can't easily ramp up even when prices spike. And silver currently has a real supply problem. The world is in its sixth straight year of a global silver deficit, using more than a billion ounces a year, while mining only delivers around 850 million. Gold doesn't have that same physical shortage. Its price is driven less by scarcity and more by who wants to hold it. Speaking of who wants to hold it, central banks have been buying gold at a pace that would have seemed extreme a decade ago, well over 700 tons a year recently. For the first time since the 1990s, gold now makes up a larger share of central bank reserves than US Treasury bonds. That's a quiet but massive vote of confidence in gold as a store of value. Silver's demand story leans industrial. Almost every solar panel manufactured needs a thin layer of silver to conduct electricity, and electronics and medical devices add even more. As the world builds out renewable energy, silver's industrial appetite keeps climbing, even as price increases have started nudging manufacturers to use slightly less silver per panel. For everyday Americans, there are several ways to actually own either metal: physical coins and bars from a dealer, gold or silver, TFs through a regular brokerage account, mining company stocks, or a specialized precious metals IRA for retirement savings. Each option comes with its own costs, storage considerations, and tax rules. Both metals share a close relationship with the US dollar. Since they're priced in dollars, a weaker dollar tends to push gold and silver prices higher because it takes more of a cheaper dollar to buy the same ounce. A stronger dollar tends to do the opposite for both metals. Interest rates matter too, especially for gold. Neither metal pays you interest just for holding it. So, when real interest rates rise, bonds and savings accounts look more attractive by comparison. Strangely, in 2025 and 2026, gold kept climbing even as real yields rose, a sign that other forces, like geopolitical hedging, were outweighing the usual rate relationship. Then there's the inflation and currency debasement story. Investors worried about government debt, deficits, and the long term value of paper money have piled into both metals as a hedge, sometimes called the debasement trade. It's not a new idea. It's the same instinct that's driven gold and silver buying for centuries. This isn't the first time both metals have surged together. In 1971, President Nixon ended the dollar's direct link to gold, freeing its price to float, and it soared through the 1970s. Then, in 1979 and 1980, the Hunt brothers tried to corner the silver market specifically, sending silver to nearly $50 an ounce, while gold also spiked on inflation fears, before both crashed hard. Both metals rallied again during the 2008 financial crisis as investors fled to safety, and again in 2011 amid the U.S. debt ceiling standoff when silver briefly neared $50 and gold pushed close to 1,900. Then came a long, quiet decade where both mostly drifted sideways. The current rally began building during the pandemic, then accelerated sharply through 2025. By October of 2025, gold had topped $4,300 and silver had touched $54 an ounce, driven by geopolitical tension, a weakening dollar, and record central bank buying. Neither metal was done climbing yet. That run culminated in late January 2026 when gold hit an all-time high near $5,590 an ounce and silver hit its own record above $120. Both metals roughly doubling in value in under 2 years. It was one of the most explosive precious metals rallies in modern history. Since then, both have cooled off. As of mid-2026, gold is trading in the low 4,000s, roughly 25% below its peak, while silver sits in the mid to high $60 range, around 40% off its own high. The pullback has been driven by a stronger dollar, the Federal Reserve signaling possible rate hikes and easing tension in the Middle East after a deal reopened a major shipping route. Here's a number worth tracking if you follow both metals. The gold to silver ratio, which tells you how many ounces of silver it takes to equal 1 ounce of gold. It's currently sitting around 60 to 65 to 1. During strong precious metals bull markets, that ratio has historically compressed as silver plays catch up, which is part of why some investors see silver as the more undervalued of the two right now. Of course, neither metal is a sure thing. Gold and silver pay no dividends and no interest, and both can sit flat or fall for years at a time. Silver, in particular, tends to swing harder in both directions than gold because its industrial demand adds an extra layer of unpredictability on top of the usual investment swings. Looking ahead, major Wall Street banks are broadly bullish on both metals through the rest of 2026, with year-end gold targets ranging from about $5,200 to $6,000 an ounce, and silver expected to average somewhere in the high 70s to low 80s. Central bank buying, persistent silver deficits, and ongoing debasement concerns are the common threads behind those forecasts. Though, as always, forecasts are educated guesses, not guarantees. At the end of the day, gold and silver tell two related but different stories. Gold is the world's oldest trust fund, a hedge against currency risk and global uncertainty. Silver carries that same trust, but ties it to the modern industrial economy that genuinely needs the metal to function. Watching how those two stories pull against, and sometimes with, each other is exactly what makes these markets worth following. So, which metal do you think has more room to run from here, gold's safe haven status, or silver's industrial squeeze? If you found this breakdown useful, subscribe for more deep dives into the money stories shaping your wallet, and let us know in the comments what you want explained next.